Welcome to this comprehensive tutorial on leveraging in finance. In this session, we're going to uncover what leverage is, how it can amplify your gains, the risks involved, and practical examples to tie it all together. Stay tuned. First off, let's define leverage. In finance, leverage refers to the use of borrowed capital to amplify returns from an investment or project. Leverage allows investors to gain exposure to a much larger position than would be possible by solely using their own funds. To understand how leverage works, consider this simple example. Imagine you want to buy a piece of property worth $100,000. You have $20,000 of your own money and get a loan for the remaining $80,000. Your leverage ratio here is 5-to-1 because you're controlling $100,000 of property with only $20,000 of your own money. Let's dive into some real-life application. Suppose you invested in a stock using leverage. The stock price goes up by 10%. Without leverage, your return would also be 10%. But with a leverage ratio of 5-to-1, your return on investment is amplified to 50%. Here's a graph to illustrate this. Now, let's flip the scenario. Suppose the stock drops by 10% instead. Without leverage, your loss is 10%, but with a 5-to-1 leverage ratio, your loss is amplified to 50%. This is the double-edged sword of leverage. A common question is, how do you determine the optimal leverage ratio? The answer depends on your risk tolerance, investment horizon, and financial goals. High leverage can offer substantial returns, but also increases the risk of significant losses. Always consider your individual circumstances. To give you a deeper understanding, let's look at leverage in the corporate world. Companies often use financial leverage to fund their business operations. This is typically done by issuing debt or taking loans. How efficiently a company uses leverage to increase shareholder returns is measured by ratios such as debt-to-equity ratio, interest coverage ratio, and equity multiplier. Consider Company A and Company B. Company A has a debt-to-equity ratio of 2-to-1, while Company B has a ratio of 1-to-1. This means Company A uses more debt relative to its equity compared to Company B. A higher ratio indicates higher leverage and potentially higher risk. Another essential metric is the interest coverage ratio, which measures a firm's ability to meet its interest payments on its debt. A higher ratio implies that the company can comfortably handle its debt interest obligations. Suppose Company A has an EBIT of $500,000 and an interest expense of $100,000, while Company B has an EBIT of $250,000 and the same interest expense. Let's see how their interest coverage ratios compare. Let's switch gears and look at how individual investors can use leverage. One common tool is margin trading, where the broker lends you money to purchase securities. Here's an example. You have $10,000 and borrow another $10,000 from your broker. Now you control $20,000 worth of securities. In margin trading, it's crucial to be aware of the margin call. A margin call happens when your account equity falls below the broker's required minimum level. The broker demands you to deposit more funds or sell off some assets to cover the difference. Ignoring margin calls can lead to substantial financial losses. Now, let's explore how leverage affects investment returns through a real-world scenario. Consider two investors. Investor A uses $10,000 in a non-leveraged investment that yields 10% annually. Investor B uses the same $10,000 with a 2:1 leverage. Let's calculate their returns after 1 year. While leverage can grow your profits, it can equally magnify your losses. Suppose the same investment faced a 10% loss instead. Without leverage, Investor A's portfolio drops to $9,000. But for Investor B with 2:1 leverage, the portfolio drops to $8,000. It's important to manage leverage prudently. Setting a stop-loss order, which is an order placed with a broker to buy or sell once the stock reaches a certain price, can help limit losses without constant monitoring. To safeguard against leverage risks, consider diversifying your portfolio. This means spreading your investments across different asset classes to reduce the impact of any single asset performing poorly. Before we conclude, Let's address some frequently asked questions about leverage. First up, is leverage suitable for all investors? The answer is, not always. Leverage is better suited for experienced investors who can manage the associated risks. Another question, what is the relationship between leverage and volatility? Put simply, leverage amplifies both the upside and downside movements, making your investments more volatile. To sum up, leverage is a powerful financial tool that can significantly amplify both gains and losses. It's crucial to use leverage with a thorough understanding of the risks involved and to employ risk management strategies like diversification and stop-loss orders.